9. Benefits Trust meeting to order. Item number 2, we'll approve the minutes for the February 14th, 2022 meeting. Can I get a motion? And have a motion and a second. Please record your vote. Item passes unanimously. Item number 3 is a presentation and investment performance report for the period March 31st, 2022. We have Doug Anderson with ANCO.
Good morning, Mr. Chairman and trustees. I hope everybody enjoyed a good weekend. The news I have is not going to be the best. This has been a very difficult start to this year. As you'll see on the screen above, we'll be covering the full performance report as of March 31st. Do you want me to just call out next slide, or do I run it from here? Okay, next slide, please. Perfect, right there. So the big news is that we've already had 2 drawdowns in the equity market this year. We had one in January, and some recovery there, and then February 24th happened, and the news has been dominated by the conflict in Ukraine ever since. Going back to the end of last year, the S&P was up almost 30% last year, so it was a great year to be an investor. But we're starting to see signs of inflation related to COVID and supply chain issues. And you can't really print more money than the entire history of the United States and not expect some inflation to happen, which is what happened during COVID. So we're dealing with 2 things right now, and I think that the Federal Reserve is the number one thing to watch right now. The Federal Reserve has a twin mandate: low unemployment, low inflation, and sometimes those things are very difficult to balance with one another. They've got they've got the third, which is a stable economy, and then the fourth is the unspoken one, which is strong financial markets. So right now, they have switched from focusing on 2, 3, and 4 to fighting inflation. And so that is the number one thing that they're going to be doing right now. And their toolbox for that has typically been to raise interest rates. And if it's a financially or a monetary policy driven inflation environment, which we are somewhat right now, that's a fairly effective toolkit. But the problem is that the inflation that we're seeing right now, a lot of that's from higher energy prices and higher commodity prices. So there's not a direct linkage between raising financing costs and lowering the barrel price of oil or natural gas or wheat or corn right now. So unfortunately, it looks like we're in a period of time that there's some uncertainty, right? There is some uncertainty. Raising interest rates in the United States is not going to cause OPEC to pump more oil. It's just not possible. So we're in this unusual situation where the Federal Reserve is reducing or raising interest rates, going into sort of a slowing economy. Now, the good news is that the first quarter, the economy slowed and inflation may have peaked already, but we just won't know for a period of time. So looking down the rest of the list here is that, we obviously have huge concerns on what's going on with Russia and Ukraine, right? This is a conflict of the type that we've not seen in Europe for a number of decades, and I think victory in Europe yesterday was kind of puts a point on that, right? We have not seen a major conflict like this that has sort of European type impacts in decades, literally decades. And it is affecting Russian and China international issues, which is also something that we haven't seen in quite some time, right? So the market is going to be markets. Also that with plural, are going to be sort of focused on bigger picture issues. It's not the next new app that's coming out. It's not the next quarter's earnings expectations. We're sort of rotating back into a more fundamental time. And we're switching back to real economy, right? So in our area, that's pretty good because we're agriculture and we're energy, and those are the 2 things that are driving prosperity or disprosperity right now. Next slide, please. Going into performance here, you can see on the top chart on the upper right-hand side, that's the performance for the quarter. We're used to seeing this positive. We've seen this positive every quarter since the first quarter of 2020. And remember how quickly things changed at that point in time, where we saw one quarter of a very difficult environment, and then after that, the markets, they rebounded relatively quickly and steadily. So for the first quarter, the S&P was down 4.6, and you can see a real dispersion of returns amongst the U.S. equity indexes. Those are the blue ones. Russell 2000 was down 7.5%. All right, so smaller companies did poor, despite the fact that most of those are more domestically oriented companies. The next set there are the international equity. So ACWI is all country, EFA is developed markets, and emerging markets were down 7%. Something that we've never seen before is the sort of unanimous, nearly unanimous reaction to Russia's invasion, where in a matter of days, the corporate world, spurred on by governments in the West and elsewhere, unilaterally or nearly unilaterally shut down Russia's ability to impact the world in a corporate way. You saw individuals being targeted with sanctions, which is unusual. You saw the Swiss banking system seize Russian assets or freeze them. And the United States has actually frozen Russian foreign reserves that are held in the United States, which is absolutely unthinkable a few years ago. They have effectively said those Russian assets are going to stay here, and you can't do anything about it until everything is resolved in Europe, and it doesn't appear to be really affecting Russia's behavior too much by now. But if we go down that list, what is making this year so far feel particularly bad is that next set of columns there that are on the negative side of the quarterly performance. Bonds are down too. Normally what happens is that when the equity markets go down, people flock to bonds, and that pushes their prices up, and it helps stabilize your portfolio. In this case, however, with the exception of TIPS, which are those inflation-protected bonds, it's the small niche of that market, bonds are down too. And what's interesting is that the best performing part of the markets is the S&P 500, right? So everything's down. Large cap US stocks is holding up better than everything else. If we look at the one-year performance, again, this is a pretty marked decline from last quarter, but S&P 500 still over through March 31 up 16%. And again, you see this pattern. MSCI emerging markets, 11.4% loss. Just to say that was mostly China for the year last year, which had a very difficult time. They're going through another wave of COVID, and it's really affecting performance there. One thing about the emerging markets index, so these are important because it tells institutional investors where their baseline or their benchmark portfolio is. Just a few days after the invasion, the index providers for the emerging markets indexes, they maintained hundreds of indexes. But they said, Russia, you're out, right? Problem is that even though they ejected Russian markets from these indexes, it was 3%, so it's relatively small, smaller than you might expect. Foreigners cannot sell Russian stocks inside of Russia. Your assets are stuck. So we froze their assets here. They have effectively frozen foreign investment inside Russian stock market over there. So it's an interesting period, and somebody who grew up in the 1970s, it feels oddly nostalgic because we have that big bad threat out there again. But if you look at the bottom one-year performance there, bonds are negative, rising interest rates, right? Rising interest rates hurt bond values, and that's what happened over the last year. I'll show that in another chart in a second. Next slide, please. So the growth value switch has happened. If you look on the upper chart there, you can see how strong value stocks, so those are banks and insurance companies and oil companies and materials companies, doing much, much better over the last year, over the last quarter. You can see the growth still did outperform over the year, but that the dispersion of returns is closing that gap very quickly, right? So we went from a market that loved technology stocks last year to something that's liking stuff a little bit more basic now. So energy, commodities, banks do better when interest rates go up, and that's why we are seeing a resurgence in the value trade. Next slide, please. As far as sectors go, just follow the one that stands out amongst everything else. That's energy, right? Oil prices way up, natural gas prices way up. And even going into a slowing economy, that's going to hurt a lot of folks, right? This is a regressive tax on people, unfortunately. But you will see that this is a part of the market. If I think back 2 years ago, I think the world was saying, the financial press especially was saying value stocks are dead money. They're never going to perform ever again. And also that technology was the place to invest, and energy is, we're moving on to a different scheme here. We're decarbonizing. But you'll see that when the going gets tough and things get a little bit more basic, that this is what people go to. It is an inflation hedge. Next slide, please. And when we look at performance here, so the green section here is on the left-hand side. That's the Russell 1000, or the largest companies in the US, and the right-hand side is Russell 2000, so those are small caps. And if you look at the returns here, it lists the sector on the right-hand side. These are the top performers for the quarter, and you'll see just what's dominating right now. On the left-hand side, you don't see anything other than energy or materials. Mosaic is fertilizer. That's what they do. So they were up 112% during the quarter, or over the year, almost 70% for the quarter. Alcoa, aluminum, US Steel, and then the rest of them are energy. If you go on the right-hand side, it's relatively similar, although there are some, there's a healthcare and an industrial there. Intrepid Potash, if you've heard anything about that, that's a farming chemical, and unfortunately most of that is exported from Belarus, which is somebody we're not doing a lot of business with right now. So next slide, please. Here is what performance looks like outside of the US. This is in US dollar terms. If I look at EM Latin America standing out, well, that's going to be well, not Argentina anymore, but that's primarily Brazil, which has an economy somewhat similar to ours. Oklahoma, like that. So heavy in industry and heavy in agriculture, and that's why they stand out so much. Next. Also notice here, the right-hand side on the lower half of that, that's the emerging markets indexes, companies there, countries. I want to point out something. It's in rank order by size. China and Taiwan are number 1 and number 2 there, and that's also an area of some political or geopolitical uncertainty. And you are seeing funds coming out of emerging markets investments right now. Institutional investors are saying, you know, if those two are almost 40% of that index, of that opportunity set, maybe we need to exit that opportunity set until things normalize a bit. And notice Russia, not in there anymore. Last quarter they're gone. So what they're saying is that what the indexes are saying is that once those markets reopen, if you hold Russian stocks, you better be very, very sure that they're going to do well, and nobody feels that way right now. Next slide, please. We're going into fixed income, and again, this is pretty painful, but what you'll notice here on the quarter, you will see that TIPS, again, inflation protected, but they still had a negative result. The next best performer are high yield bonds. So that's basically because high yield bonds have a shorter duration or less interest rate risk because their maturities are shorter than the rest. Corporates did poorly, but treasuries were also, again, pain everywhere in the bond markets right now. The good thing about that is that yields are up, so looking forward, our returns are better, but they look better going forward. Unfortunately, we've had this painful transition period. Next slide, please. I'm going to focus on these two charts, and I know that bond statistics are not fun for most people, but just taking a look at this. The upper right-hand side, these are one-year trailing market rates. So these are interest rates looking backwards over 1 year. You can see the gray line is flatlined at the bottom until the Fed raised to 25 basis points already, and we've gone 50 since then. So that's even higher. It's getting close to, it's 75 basis points, which is as high as this chart shows. The green line there is the 10-year Treasury. You've heard bond yields are up, and the chart below also shows this, but the 10-year Treasury bond yield is above 2.5%. It's getting close to 3% right now. And then you also see what is the high yield OAS, and I'll translate for you. That is the option adjusted spread between high yield bonds and Treasury bonds, right? So if I buy a corporate bond, I want to get paid more than buying a Treasury because there's more risk there, right? The US Treasury will always pay. Corporate bond issuers don't always. But when you see the the Treasury bond yield going up, but the OAS, which is how much I'm demanding to be paid for holding that riskier bond, that's going down. In an environment like this, normally that's going up because corporates are less, their revenue streams are less certain. But what this is telling us is that this is inflation that's driving the yield up, but corporate America is taking advantage of inflation to raise prices across the board, right? Just go to the grocery store or gas station. We've all seen it. So this chart is saying that's unusual and quite important is that the risk of owning corporate bonds in perception-wise and relative terms is going down, but the risk of holding bonds in general, Treasury bonds, is going up because of inflation. So this is highly unusual. If we look at the Treasury yield curve there, the yield curve has been very tightly restrained for decades, literally, but since the COVID crash, it's been very carefully maintained. And if we look at the yellow line, that is the Treasury yield curve. That tells you the yield of various maturities of Treasury bonds as of 3/31. And if you will look at that compared to 12/31 of last year, those are massive increases, right? Mortgage rates, which is something that all of us are probably pretty familiar with, have gone from below 3 to about 5%. And that's a huge impact. Even though housing market's staying very strong right now, but going forward, that could have some impacts. And that's what this is saying, is the Federal Reserve is saying, we're gonna allow interest rates to go up because that will slow economic activity. In fact, we're gonna push some of the rates up that we have control of at the short end of the curve. But to slow down the economy enough for inflation to go down, there's gonna be some pain, right? There's going to be some pain out there. And the unkind word is demand destruction, but we can translate that into economic slowing or recession going forward. So next slide, we'll start to get into the report itself. So we still have a trailing year as of 3/31 return of 6.8%, right? We can be thankful for that. If we look on the page 14, looking at this bar chart, you can see a drawdown. We've had drawdowns before, though. If you look at it for the first quarter, it seems pretty sharp. And you have to go back to the first quarter of 2020. That was worse, right? And again, when we think about high volatility markets or times that we have drawdowns like this, when we see volatility accelerate to the downside, volatility also during those periods of time accelerates to the upside. And what I'm saying is that big down days and big up days are clustered very close together. And that's why we stay invested in the marketplace, because if we pull the ripcord right now and say we're out, then we will miss the recovery in the equity markets. And again, we never know what's going to happen. So the net cash flow over time, you can see, is started out in 2009. It's been fairly steady over that period of time, so $52 million have been paid in. The portfolio's market value is $97 million. So we've compounded nicely. And over that period of time, so I just want to point out the net contributions. So total contributions have been $152 million. 105 has been pulled out. So you can see this is very active from a cash flow perspective. Funds going in, funds going out to pay benefits. And then you can see that the gap between the blue line and the gray, that is the compounded returns over time. I'm going to go quickly to page 16. We did go below our $100 million threshold, unfortunately, during the quarter, but the asset allocation did not change much. If we saw a massive drawdown in the equity market compared to everything else, you'd see some change. But I look at the chart on the left and I look at the chart on the right, and even though I do wear prescription glasses, they look very similar to me, right? And unfortunately, that means that all asset categories were down. And then if I go to the following slide on page 17, it's largely similar to that, although there are some modest changes. I want to go to page 18 for the first quarter financial reconciliation. The total fund started the quarter at $103 million, ended at 97.7, and it was depreciation. Almost all of the portfolios were negative during the quarter, as you would expect. There was one that was positive, and we'll get to that in a moment. That's the mid-cap value portfolio. They've invested heavily in energy, which was a big drag for a few years, but now it's coming around quite nicely. And when I go to pages 19 and 20, showing the individual returns here, so the total fund net of fees was down 5.23% for the quarter. Trailing year still up 6.78%. Unfortunately for the quarter, the fund ranked in the 71st percentile, first being highest, 100th being lowest. So being a lot of investment in some of the sectors of the market that didn't do great. So we suffered during the quarter. If I look at the 1 year, the 3 year, the 5 year, and the 10 year, we're at or near top decile amongst the funds in the universe. This is all public plans in the same market value, rough size here. So performance has been very strong, even though benchmark has been even better than we have over that period of time. So looking down the 1 year return, you can see that the total fund, 6.78% net, 11th percentile amongst that universe. Total fixed income, even though it was a loss, ranked in the 3rd percentile of the fixed income universe. The benchmark was down 4%, 4.15. Our total fixed income portfolio is down 1.13. So I'm very pleased at that. Fixed income is 25% of the portfolio, but it's an area that I think that with good work, selection, and structure, you can outperform that index fairly dramatically. So if I'm looking down that list on the last 1 year, so Loomis Sales Bond, down less than 1%, so they outperformed their benchmark by a significant margin, and that ranked in the 1st percentile of their peer universe. If I look at Double Line Bond, they were down 3.44, but still outperformed the index and ranked in the 14th percentile. Now, Lord Abbett, our high yield bond portfolio, was down 1.01, so not quite as good as the other two in relative terms. And then Hoisington, which is that all Treasury portfolio, which suffered definitely during the first quarter. Over the last year, it was positive, and it ranked in the 2nd percentile of that peer universe. So a little bit unorthodox that they don't own any credit, and they have 100% long-term Treasury bonds right now. But if they think inflation is anything more than transitory, they will shorten down to 91-day T-bills. The total domestic equity portfolio here over that 1 year period of time was up 12%. The S&P, again, was up 15.65%, so extremely good results. But I think that the days of the S&P 500 leading the rest of the investment world are probably behind us for a while. 32nd percentile for the total fund. If I look at the Fidelity Fund, we don't have a trailing 1 year return. Remember, we switched to Fidelity because it costs less than what we had before, but their returns are spot on the benchmark. The mid-cap index was up 8.82%, and those returns continue to be quite good. And then Hotchkiss & Wiley, the portfolio that we probably weren't really excited about last year, going into the 4th quarter, probably over the previous few years, has turned around quite dramatically, 21.7%. And again, that's much better than the S&P 500. And the 3 year return has risen up to 33rd percentile. So I'm very pleased with that, and thank you for your patience. They didn't become poor money managers all of a sudden. They were just in the wrong part of the markets, and they were very, very stubborn. And we're thankful for that now. Looking at our Stevens small cap portfolio, so this is small cap growth, dramatically different. It was down, but down not nearly as much as its benchmark, ranked in the 12th percentile. And then Causeway, the international equity, international value equity, struggled. So that is a fund that we're keeping a very close eye on. They did have some emerging markets exposure, but they've done pretty well. Good news about that is that they do own some of the larger value-oriented companies in Europe right now. So the performance has stabilized. I want to go to the next couple of slides here, just showing calendar years. So last year, the total fund at the very top was up 17%. 2020, the portfolio was up 15.87. In 2019, the portfolio was up 22.25. 2018 was the last down year that we had, but down 5.21%. And what I'm trying to point out here is that markets are volatile. They are volatile in our favor most of the time, but sometimes they are volatile in the other direction. And as I go down the list for our portfolios here, for 2021, it was a tough year for bonds, especially long duration bonds, but the total fund did very well. If I look for the total domestic equity, 34th percentile at 26% gain. And that was when Hotchkiss first started to do well, but the mid-cap index was up 24.5%. Going down to the out years for Stevens on the following page, you can see that they're down 12.5% year to date. Last year, they were up 14.3. The year prior to that, they were up 37. The year prior to that, 23. And even in 2018, 3.26%, which I have to say I'm pretty pleased with their downside protection, right? Their market's off much more than they are. And sometimes when the market rips higher, they lag, but one of the reasons that we have them is because they have the profile that when markets go down, they protect a little bit better. And then Causeway, international equity has not been a great place to be. And with the US dollar being strong, it's probably going to be that way for a little while longer. So one final thing I want to show here on performance-wise, it's the very next slide, and this shows risk return. It shows risk return of the total fund versus its neutral market benchmark. And on the left-hand side is the last 3 years, and I want to pay attention to the table and the scatter chart that has 2 dots exactly on it. So over the last 3 years, the total, if we look at the return, oh, I'm sorry, that's the Loomis Sales bond portfolio. When I'm looking at that return, you can see that it's been very strong, that it has strong upside capture and the downside capture is lower, and that's what we want to see. And that's pretty typical of the overall portfolio. We have good upside participation, we have good diversification, and we have a lot of smart managers where we think that they can add value. I'm going to make a big page flip here, going to page 44. Perfect, right there. So we have one manager who is on alert as of March 31st. That's Hotchkiss & Wiley. We were waiting for their 3-year return to go above average. It is in the 33rd percentile. So I recommend moving that to in compliance as far as that goes. On the next slide is the fee summary. This is very important as institutional investors. We need to make sure that we're paying very close attention to how much we're paying the investment managers here. The standard that we're held to as fiduciaries is reasonable. We don't have to be lowest, but we have to be reasonable. If I look at the expense ratio for the total management fees here, it's a weighted average 44 basis points. If I take the average fund in each of those individual categories, it would be 90 basis points. So we're even more than half off of what the average is, and that is reasonable. That saves the fund about $400,000 per year. So we're pleased with that. And the next few slides are our dashboard for the international or the total fund compliance. It says that our quarterly return, we were outperformed by the policy index. 3 years and 5 years we were. But do remember that we're in the top decile amongst all funds like ours, saying that benchmark was almost impossible to beat. If we look at equity, fixed income, and cash, we're all in compliance there. And then one final slide I'd like to call attention to is on page 49. This is our asset allocation policy. You will see that on this list, or on this, the charts, or the chart at the bottom shows you where you are relative to your benchmark or your target allocation, and then relative to your policy. So if the individual categories show a green triangle, if that's where your asset allocation is, you're in compliance with policy. All categories are in compliance with policy, and you'll see that domestic equity is kind of getting close to the top range of theirs. We're okay with that, especially with bonds being pretty uncertain right now. But if we will be adding assets, it'll be going to fixed income. If we'll be taking assets to pay benefits soon, we'll be taking it from domestic equity. And I know it's painful, but that's how we maintain our discipline here. So I'm happy to take any questions. Tough quarter. Patience is always required in the game of investing, and I don't think that we appreciate it enough until we get to an environment like this. But our discipline, our selection, and our process is really what got us here into the top decile, and it's what will keep us here.
All right, any questions for Doug? All right, thank you, Doug. We'll go to item number 4. It's receive the monthly investment flash report for February 28th, March 31st, and April 30th. I think you're just going to focus on April 30th,
Okay.
which April was not a good month.
No, it was not. It was, again, April was if we go to the next slide, April is really when you started to see so if we go back to February, that was at the very end of the month, that was when the invasion happened, so there was some uncertainty in the marketplace before then. March was sort of a relief quarter where it wasn't as bad as we initially thought it was, so markets traded higher, but then when we go into April, it's a tough time. We have not seen a year start out like this in past 80 years. So this is an unusual environment that we're in right now. Again, if we look at the charts here for the year-to-date equity sector performance there is one sector that is positive, and it is energy. Next slide, please. The drawdown here is that it looks even worse than the COVID drawdown. So that's where we are right now. And the next slide, we start to show performance. So for the year-to-date period, we're down 12%, and that has taken our one-year return down into the negative territory. All of the fixed income portfolios are negative. You can see some slight positive returns on the Fidelity 500 Index Fund. Mid-cap index is down. Hotchkiss & Wiley is still up. Then Stevens is also down. Performance versus benchmarks is where you might expect it to be, given the risk profiles of all of these. But even the Bloomberg Aggregate Index, that's the bond market, is down 8.5%. Bad news is that we're down 8.5%. Good news is that yields are higher going forward, and that's the number one determinant of returns. I think we would all be comfortable in a world where interest rates are a little bit higher than they have been, because that means the economy is healthy. It's just that transition is very, very painful. Expense ratio is unchanged over this period. So any questions on this?
Any questions? All right. I'll take a motion to receive the monthly investment flash reports. Item 4. A motion and a second. Record your vote.
Do we have any control over these lights? Those are pretty harsh, the ones on the wall.
No, we don't.
That's not.
Go back to computer here. There you go. So to come off of presentations, you have to push computer.
Motion passes unanimously. All right. Thank you, Doug.
Thank you.
Item 5 is approve the fiscal year 2023 annual budget, establishing revenue expenditure budgets for OPEB. We have Doug Dowler, our assistant finance director and budget director.
Thank you very much. Glad to be here. And actually, it's kind of a remarkable budget that I'm presenting to you in terms of how level it is. Very little has changed in the dollar amounts for the budget for this coming year. And the primary reason we've got more participants, but they've made some slight changes in terms of the plans that they're participating in. We've seen a higher participation rate in the indemnity PPO alternate plan as opposed to the standard plan, and that plan's about 40% cheaper than the standard plan. So as more people have selected that plan, we actually have more people, but it's costing us less than it was before. Although, again, slight increases in the HMO and the indemnity premium, a few $100,000 between them, but across a nearly $30 million budget, that's just a very negligible change. And so you'll see those across the board in nearly all of the categories on revenues and expenses, very small changes there. The subsidy from the general fund maintained at $13.3 million for the coming year. It stayed at that level for a number of years and will be sufficient to continue to contribute to reserves. Next year we expect a little over $3 million will be added to reserves with this budget and with this level of support from the general fund. So with that very general overview of where things are, I'd be happy to answer any questions that you may have on the budget.
All right, any questions for Doug? All right, seeing none, I'll consider a motion. your vote. And the budget passes unanimously. Item 6 is to ratify the claims listing. Staff's here to answer any questions if you have any questions regarding that. If not, I will consider a motion. Motion and seconds, and the item is approved unanimously. Item 7 is our external audit contract, an addendum between the Oklahoma City Post-Employment Benefit Trust and Allen, Gibbs and Hulick, LC, audit firm for fiscal year 21-22. This is a trust, it's a standard, our contract renewals, estimated cost is around $24,000. And this is year 7 of 7, so we'll be bidding this out this next year. Okay. Consider a motion on A. Motion and second. Record your vote. Passed unanimously. Item 7B is renewal of agreement between the Oklahoma City Post-Employment Benefits Trust and BOK for custody under the same condition as approved on May 10th, 2021. This is in year 2 of 5 years of the contract, and it's based on the current assets in the trust. The annual contract we anticipate to increase by $3,000. With that, I'll accept a motion. Record your vote. And it passes unanimously. Now we're to item 8, report comments from trustees, staff, and interested party. Do we have any from the trust, staff? All right. And then seeing that we're at the conclusion, item 9, we are adjourned. Thank you.